Good morning. Brendan Rendo, the Homes Orlando team, joined by Joseph Dion. And this is the Orlando Real Estate Buzz. We bring you economic news that affects the housing market every week. Morning, Joe.
Good morning. How are you doing today?
Doing good.
Economic news is going to be fun. We're
Yeah.
branching out a
Yeah.
little bit today. I think we're not just talking mortgages.
We'll get there. We'll get there. We looked at it this week and wanted to bring up something that's really a concern for homes sales long term. And what that is the economics and the household debt that's exploding
Yeah,
currently in the United States.
right. Yeah, and we've seen that. We're coming out of what was in a crazy buying season with low interest rates, stupid craziness, and we've seen this on the mortgage front. But what really we haven't talked about so much was all the other debt that everybody's been buying and accumulating over the last 2 years.
Yeah, yeah. It's been huge. It's been huge. And the New York Fed just came out with their report this week, and big headlines was that we are reaching nearly $1 trillion of credit card debt.
Wow. But it's like it seems so crazy, right? We had all these stimuluses, we had this, and we were talking about credit card usage was at an all-time low and balances were dropping and everything else. But that changed really, really fast the moment we all could leave our house again.
Yes, exactly. Everybody, oh, let's get out. I need to release, go have some fun, go on vacation, do this. But when you look at this chart, I mean, it's just been, even since 2012, just a steady increase
Mm-hmm.
where non-housing debt has reached a level of $4.5 trillion.
Mm-hmm.
That's a lot of money. That's a lot of money. I mean, student loans, you're sitting at 1.6 trillion. Other, I don't know what the other is yet. Half a trillion.
Mm-hmm.
But credit cards, $90.99 trillion.
Yeah.
I mean,
That's a
we're
rounding
right
error right
there.
there.
And I understand with people with inflation going up, savings is gone, has hit new low levels.
Mm-hmm.
Um, People are having to dip in to their savings.
Yeah.
I mean, I think one thing we've seen is quite honestly is an explosion in the home equity lines. So all
Mm-hmm.
this equity that people have built up, they're starting to use it, to stay afloat. It's kind of scary overall.
Yeah. And one thing that's kind of lost on that too is right all of this is going to go up because interest rates went up. So like
Hmm.
the credit cards that might have been at 12, 14, 15, 18% are now sitting at 24, 28, 30%. And try to get ahead on that credit card debt when it's increasing at such a high rate.
Exactly. And what a lot of people don't realize is that it affects your credit scores. Is
Mm-hmm.
the higher the balance you carry, the higher the percentage, the lower your credit score goes. So your
Mm-hmm.
credit score goes down. Guess what happens to your interest rate if you want to buy a house? It goes up
They go up.
because they do the adjustments. And then the other thing, and I think this is one thing you notice with the sensitivity of consumers with mortgage originations going up and down, up and down, up and down. It seems like every week, it's I mean, a quarter of a point makes such a big difference because people's debt to income ratios are so tight
Yeah.
overall.
Mm-hmm. Yeah.
And that's, one thing you tell people, I think, consistently is, when you're getting ready to buy, get those credit cards paid down. Get them down because, we've got to, look at your overall debt to income ratio.
Mm. That prep before the actual real work, right? Like before you get pre-approved, like the things that consumers and general population talks about all the time is, credit card debt, consumer debt, minimizing if you're able to pay down, pay down. But it's kind of like, well, you got to pay down, but you got to save up. And I feel like the conversation I'm having most days right now with borrowers is like, oh, I can't afford to save up because I'm trying to pay my credit cards, but they're not really paying down their credit cards either. So I'm kind of sitting there going, it's a tough spot, that affordability. And it's kind of just like, I talk to more consumers now than I've ever talked to, where you look at it and you're like, you make 3,000 a month, but you got a $900 car payment. Like,
Those are the crazy ones.
it's going to
Those
be
I
really
just
hard
I
to
don't
do
get.
anything when a third of your income is a car payment. But on average right now, I think the amount of borrowers with over $1,000 car payment, like it's the highest it's ever been. Like it's cars and vehicles like long gone are being able to have a reliable vehicle for 30K. Like now it's
Yeah.
60, 70, 80, $90,000 for these vehicles. And during kind of I kind of feel like COVID and the change, everybody kind of did it, and there was a shortage, and then it was like, oh, we're paying more because we wanted it. They wanted that little bit of luxury that they didn't have
Hmm.
before. So we saw these payments kind of increase, and they have a much bigger impact. That's something like the credit cards, the auto loans, these are all things that have an impact on your ability to buy.
Yep. Yep. And it just, you got to look at your long picture is, okay, I want to own a home. Do I need that car payment of $800 a month?
Mm-hmm.
And if I'm going to, if I know my debt to income is going to be, can't go over 50%, I've really got to look at that.
Mm-hmm.
And, maybe I got to go back to that Toyota Corolla. But you
Yeah.
know what? I'm going to own my home.
Yeah.
I'd much rather own my home
Yeah.
than my car, or than have a debt on my
Rather
car
an asset that appreciates than one that depreciates.
than depreciates. Exactly. Exactly. And it was interesting because within that report that the New York Fed put out, this is a number of accounts by type, and we've seen since 2020 again an explosion in credit cards.
Wow. Yeah.
More people taking out, getting credit cards. And then this I found interesting because we had that discussion a couple weeks ago about everyone screaming about, oh, all these people with the low credit scores they're gonna be be getting loans, they're gonna be paying less. This is mortgage originations by credit score.
Wait a minute. Is that dark
This
blue?
list,
Yeah. What is that? That
yeah,
dark blue all the way at the bottom? Is
down
that?
there? Here, let me blow it way up. Hold on, so we can see it. See that little bitty blue down there?
That blends in with the black?
That's 620 and below. That is 620. And look at this, even between 620 and 659.
Still very minimal.
It's just that little gold sector.
Yep.
So these people aren't getting mortgages. The vast majority are 660 and above.
Which kind of goes entirely in line with what you and I were talking about, is like, just because something changed doesn't mean that they're going to now be all of a sudden get a whole bunch of mortgages. Like, they still got to qualify. And usually when you're in that situation, you're not qualified.
Exactly.
There's other things that are holding you up from being able to buy.
Exactly. It's clickbait. It's nothing more than clickbait. And I swear sometimes they do it just to rile people up.
Yep.
Let's just piss everybody off today. And here you see again, same thing, origination, your scores. 50% of the people are 760 and above.
Yeah.
And then right now, 90% of the people are above a 650.
Wow. So the majority of people are above 650.
Majority of the people above 650. This was kind of fun to look at. This little thing down here. Remember 2006, 2007?
Yeah.
It would breathe. This is right about that 580 mark. Remember that golden, if you got a 580, we can get you 100% financing.
It's done.
You can get you done. Yep. So you go back and you look at these things, and you can see it. These charts are a lot of fun some days to look at. And then the other thing that's getting a little scary is our delinquency rates. And you're seeing these are 30-day delinquencies by type.
Yeah.
What are we talking about? Auto loan repossessions?
Yep.
Credit cards.
Right up.
Your percentage of credit cards that are 30 days late now has jumped up.
Mm-hmm.
And you want to talk about smacking your credit score?
That'll happen really quick. Bad. Yeah.
Yep.
You see,
boom, you're going to drop 40, 50 points. Yep. And if you've got a 30-day late in the past 12 months, right? Not easy to get a mortgage anymore.
Yeah, I mean, you're allowed one per se, but I mean, it's a lot harder to get approved. Like, it's not like, one thing that you see there is student loans that since the moratorium on student loan debt been flat, almost zero.
Yeah, the pretty red one.
Well,
Yep.
yeah, what's going to happen is student loans. It's getting ready. Payments are about to restart. I guarantee we're going to see that skyrocket. Because that's the one thing nobody's been.
And then the gold one here. Yeah, the gold one here is mortgages. And you see, we hit really a low historically back in mid 2021.
Mm-hmm.
But we're slowly starting to creep up toward probably about 2.5. Getting close to 3% or 30-day lates.
Mm-hmm.
And then we hop over into the 90 days. This is what they call seriously delinquent. Here we are again, over almost 5% of credit cards are over 90 days late.
Yeah.
And same thing with your auto loans. Your auto loans have popped up to over 2%. So these are signs, of economic slowing.
Mm-hmm.
When you start seeing all these lates, and this inflation is bad for people.
Mm-hmm. Yeah.
When people got to make decisions on what are you going to pay? Are you going to eat, or are you going to, make that payment on that credit card? I mean, it's
pretty easy decision to make.
Not a great thing for a lot of people.
Yeah.
So, but I mean, when you look at that, and then you look at the example that our federal government sets for us. This was the 16th was the last report. Our federal government has a whopping $94 billion in the checkbook right now.
Woo!
That's it. And look what they spent in a day. $167 billion.
That's a lot of money.
And this was looking at the reports. This was one of the first days in a while where they actually took in more deposits than they spent for once. So our checkbook actually went up a little bit.
Yay!
But this is the stress of everybody with the, are we going to default? Are we going to, do you really think we can get to June 1st? I'm sure Yellen's doing some real creative financing on that end. Let's carry. No, we're not going to carry the one. We've got to do this and
rounding errors.
The government vendors don't need to be paid in 30 days. We'll stretch it out to 60. So, but we wanted to go over the household debt, because if you're looking to buy, you got to understand it. You've got to look at it as an overall big picture. Is what's your goal? If your goal is to buy a home, you've got to understand that every part of your debt structure, affects that purchase, affects your purchase price.
Yeah,
affects your pricing on your mortgage. So it's it's concern overall. You never want to see anyone default. You never want to see anyone struggle. So just be aware of it.
Yeah.
Be aware of what your big picture is. And if you ever got any questions, call us. We're here to help.
Yeah.
Not to judge or anything, just truly help you put together a plan. And you and I both worked with people for 6 months to even a year, even longer, giving them an outline. Give them an outline. Hey, this is what we need to accomplish, and we check in with them. We got one right now, Miss Maureen. They've got certain things they got to do. They're looking to buy their house in September, and we're touch base with them yesterday, making sure, hey, let's are you on schedule? Are you doing this? Are you doing the right things to be in position so we can get you that house that you're renting right now that you can purchase?
Exactly.
So, well, that's economics today, and then we're going to get back into
the mortgages, real estate,
Orlando housing market.
There we go.
This is boring. This has gotten boring the past couple of weeks.
It's been pretty stable, right? Like nothing crazy.
It's very stable. It's very stable. I mean, we came down about 20 units, 420. Our median price is holding steady right where it was.
Yep.
Inventory dropped by about 22, so kind of flat line, overall. Condos and townhomes, same thing, very, very consistent overall. And we come back in and we look at, our final list price to sales price. This hasn't moved hardly at all. We're sitting right around that, 97.5, 98 percentile. Not, again, because of the inventory, not as much wiggle room.
Exactly.
As there has been in the past. And our days on market is staying very consistent. Right around that 45-day mark is where, most houses right now are selling. So consistency is not a bad thing at all.
Yeah, we'll take it. Yeah, we'll take it right
we'll see
now.
Here chart wise. Yeah, I'll take consistency any day of the week. And you can see here chart wise, we are really just holding that line. We don't want to see. We are in the spring market. You would expect it to pop a little bit, but I think because of the interest rates,
I think we're going to see interest rates. We're seeing those chinks, right? We're seeing kind of the market adjust a little bit. We're seeing, debts go up, and these are all things that are kind of saying, hey, we're going to see an adjustment at some point. I'm starting to see kind of experts talk about interest rates might potentially drop tail end of this year, whereas before it was a lot wider range. We're starting to hone into when we think things are going to happen. So I think we may see our traditional buying season of that spring, early summer may be a fall buying season. Like we may see a little bit of a shift this year than what we normally do.
Yeah, and I think a lot of it depends what the Fed does in June.
Yeah, I agree.
I think they're going to hold. I think they'll hold. I think we've seen enough. I personally have seen enough slowdown in the economy overall.
Yeah.
That they can hold it.
Yeah, I think I'm in agreement with you.
Good. Yeah, I think we get good inflation numbers, or continue that slope down. I think they can hold overall. And here goes our total actives. And you see, really past 3 weeks kind of leveled out, sitting right around that 350 mark. Man, I just want to get that up. I was hoping to see that. Most schools are done this week, next week.
Next week, I
Orange
think.
and Summer County.
Yep.
Yeah. So I think now, hopefully over the next couple of weeks, we'll see that pop up, where maybe we get a week where we've got 100, 150 new listings. Positive.
Yeah, that'd be positive.
Yep. Then we go into the condos. Condos just sitting the same thing, sitting right around that 98% overall. Very tight. I mean, this is between the 250 and the 300. It's pretty much at list.
Yeah.
They're not coming off right now.
No.
And days on market, they're consistent as well, sitting at that 46 days on market. So overall, we're back. We're very consistent. Orlando's just a very consistent overall market.
Yeah.
Which, compared to a lot of other places in the country, be happy. Be happy. I mean, did you watch the video I sent you on San Francisco's commercial real estate?
I started to watch it. In the commercial real estate, that's going to be an interesting sector. Like we're talking like nationally, commercial real estate, they're at a 20% vacancy rate nationally. And obviously San Francisco, much, their doom and gloom of all of this is kind of like, it's tough. Like, what is that picture going to look like though? When we looked at personal, right? Like today, like personal debt, but you start getting into, commercial loans, and most commercial loans are, they're usually through regional banks, not your big national banks. So if the commercial, they don't have the rents to pay their debt, and then they can't pay, and they're mostly being funded by regional banks.
That's why we're having a lot of problems with the regionals, is they've got all this. They're allowed to count it at full value, but when you actually do the numbers, that property's worth half of what they've lent on it right now. And it's just, it's what we got. We're close to $2 trillion, something like that, in commercial paper that needs to be refinanced soon. How do you do that when you don't have renters? How
Yeah.
do you underwrite a loan like that? You can't.
Mm-hmm.
So, well, thank you, everyone. Hope this was informative. We enjoy it. We'll see you next Thursday. And please don't forget to like and subscribe so you can keep up to date with everything that's going on in the housing market. Take care, Joe. We shall see you later.
Sounds good. Rock it out, guys.